It is December 10th, 2025. The final Federal Reserve meeting of a chaotic year has just concluded. Jerome Powell walked up to the podium, and with a single sentence, he confirmed what the bond market has feared for months. They cut rates again. A quarter-point cut, bringing the policy rate down to a range of 3.5% to 3.75%. On the surface, this sounds like good news. It sounds like relief. But if you listen to the Q&A session, if you parse the trembling in the data, you realize this wasn't a cut from a position of strength. It was a cut from a position of fear. Powell admitted that the downside risks to employment have risen. He admitted that the economy is slowing. But at the same time, he acknowledged a new monster in the room. A monster that the Fed cannot kill with interest rates. Tariffs? Let's dig into the most shocking admission from this press conference. It happened when Powell was asked about the job numbers. For months, we have seen headline numbers that look okay, but Powell just pulled back the curtain. He explicitly stated that there is a systematic overcount in the payroll data. He believes the official numbers are overstating job growth by 60,000 jobs per month. Do the math. If the official report says we added 40,000 jobs, but the error is 60,000, that means the US economy actually lost 20,000 jobs. We are potentially already in a job loss recession, but the data hasn't caught up yet. The cooling labor market he talks about is actually a freezing one. The supply of workers is down due to immigration restrictions. The demand for workers is down due to economic slowing. And yet, the unemployment rate is slowly creeping up to 4.5%. The buffer is gone. Now, here is the nightmare scenario. Usually, when jobs disappear, inflation disappears too. But not this time. Powell spent a significant amount of time talking about goods inflation. Why are prices of goods going up again? Tariffs. He called it a one-time price level shift. But we have heard transitory before. The new trade wars are forcing prices higher at the exact same moment the consumer is running out of money. This is the textbook definition of stagflation. Stagnant growth. Rising inflation. The Fed is cutting rates to save the jobs, the maximum employment mandate, but by doing so, they risk fueling the inflation fire caused by the tariffs, the stable prices mandate. They are trying to drive the car with one foot on the gas and one foot on the brake. And what about the savior of the economy? Artificial intelligence. When asked about the disconnect between high GDP growth, 1.7% to 2.3%, and the weak labor market, Powell pointed to productivity. He admitted we are seeing a productivity shock, potentially driven by AI and automation. This sounds great for Wall Street. Higher productivity means higher profits for corporations. But for the worker, it explains why companies are firing people but still producing more goods. We are witnessing the jobless recovery. The GDP goes up because the machines are working. The unemployment goes up because the humans are not. Powell admitted the Fed has no tools to deal with the social implications of this displacement. They can only manage the money supply. They cannot manage the structural shift of the workforce. There was an elephant in the room that Powell tried to dodge. The political pressure. Reporters asked him about the president talking openly about a new Fed chair. They asked about the Supreme Court. Powell gave the standard, "We are focused on our mission" answer. But the timing of these cuts tells a different story. With the 10-year Treasury yield rising, the market voting that inflation is coming back, the Fed is fighting the market. Powell insisted that the rise in long-term rates is due to growth expectations. But is it? Or is it the bond market demanding a higher premium because they know the US government is issuing too much debt to pay for the tariffs and the deficits? The neutral rate conversation is shifting. We are realizing that we might never go back to the low rates of the 2010s. The new normal is higher rates, higher debt, and higher volatility. 5 to 6 o'clock. Conclusion. No risk-free PTH. Jerome Powell ended with a sobering line. There is no risk-free path. He knows. He knows that if he cuts too fast, inflation explodes. If he cuts too slow, the job market collapses. December 2025 marks the moment where the soft landing narrative officially died. We are now in the hard choices era. As we head into 2026, watch the data that isn't being reported. Watch the revised job numbers. Watch the price of goods at the shelf. The Fed has surrendered to the reality that they cannot control the supply chain, and they cannot control the government's trade policy. They are passengers on a bus that is speeding up just as the road is running out.